Bond prices. Relationship between coupon and yield. If YTM equal to coupon rate, then par value equal to bond price. Here, if yield to maturity is equal to the coupon rate, that means if it is 10% instead of 8%, then bond price would be 1000, which is equal to face value. When yield to maturity and coupon rate is same, then bond price and face value or par value is also same. If YTM greater than coupon rate, then par value greater than bond price. Here we can see that here your yield to maturity is 11%, which is higher than coupon rate. So in that case, your par value is also higher than your bond price. So when yield to maturity is higher than annual coupon, then par value is also higher than bond price. Similarly, if YTM or yield to maturity is less than coupon rate, then par value less than bond price. Here we can see that your yield to maturity is 8% and your annual coupon is 10%. So here yield to maturity is less than coupon payment. So that is why your par face value or par value is less than the bond price 1196.36. Here we can see also a graphical relationship between price and yield to maturity. Here the bond characteristics are that it is a 10-year maturity bond and the bond will pay 8% coupon rate yearly and bond par value is $1,000. So we can see that when the yield to maturity is 12%, then bond price is almost 780. When coupon rate is 8%, when yield to maturity is 8%, then your bond face value is 1000. So that means when YTM and coupon rate is same, then your par value and bond price is also same. So we can also see that when YTM is 4%, in that case your bond price is almost 1300. That means when your YTM is less than coupon rate, then bond price is higher than par value. Here is an example for more understanding. If an ordinary bond has a coupon rate of 14%, then the owner will get a total of $140 per year. But this $140 will come in two payments of $70 each. The yield to maturity is quoted at 16%. The bond matures in 7 years. So here your coupon rate is 14%. the owner will get $140 per year, but this $140 will come in two payments of $70 each. That means in a single year, you'll receive $140 in two times. In the first time, you'll receive $70, and the second time, you'll receive $70. So it is normally semi-annually. So here your coupon payment is semi-annually, and your L2 maturity or record rate of return is 16%. And bond maturity period is 7 years. So how many coupon payments are there? So here we have already got the answers that you have $140 divided by 70. So you have two coupon payments. Now we have to find out what is the bond price. In our example, we can see that coupon rate is 14%, which is semi-annual coupons. YTM is 16%. Maturity is 7 years. Par value is 1,000. So since your coupon rate is 14% and it is semi-annual, then your coupon payment in semi-annually, it should be 14% by 2. It should be 7%. Similarly, since your YTM is 16%, for semi-annually it should be 8%. And your maturity period is 7 years. But your coupon payment is semi-annually. Then your maturity period will be 7 into 2, which is 14. So your total maturity period is 14, and par value is 1,000. So here we can see the bond value equations. So your coupon payment at 7%, your coupon payment at 7% on 1,000 is 70. 1 minus 1 divided by 1 plus your YTM semi-annual is 8%, 0.08. And maturity period is 14, since it is semi-annual, divided by your YTM 0.08, plus your face value is 1,000, divided by 1 plus YTM 0.08, power maturity period 14. So here you can get your bond price 917.56. Similarly, using calculator, you can also find your PMT. Press 70 for PMT, 14 for N, 8 for interest, 1,000 for face value. Then press CPT PV, you will receive. You will get your bond price, which is 917.56. Here you can see that your bond price is 917.56, but your par value is 1,000. We have already learned that when bond price is less than par value, that is called discount bond. So here the investor capital gain is the difference between par value and bond price. They will also receive $70 coupon payments in each period. Interest rate risk. Interest rate risk is originated from the fluctuation of interest rate. The risk that arises for bond owners from fluctuating interest rate is called interest rate risk. How much interest rate risk a bond has depends on how sensitive its price is to interest rate changes. This sensitivity directly depends on two things: the time to maturity and the coupon rate. Interest rate risk can be divided in two forms. One is price risk, one is reinvestment risk. Price risk occurs due to the change in price in interest rates. Change in interest rates. Long-term bonds have more price risks than short-term bonds. Long coupon rate bonds have more price risks than coupon rate bonds. Reinvestment risk is a risk of uncertainty concerning rates at which cash flows can be reinvested. If investor cannot reinvest their capital in the current price, then reinvestment rate risk occurs. Short-term bonds have more reinvestment rate risk than long-term rate bonds. High coupon rate bonds have more reinvestment rate risk than low coupon rate bonds. Here we can see an illustrator for making these things more understanding. Based on the maturity period, the bond price risks also vary significantly. When interest rate is 5%, in 1 year the bond value is 1048, and in 10 years it is 1386. So here we can see when bond interest rate increases to 10%, then bond value in 1 year decreases at $1,000, and in 10 years it decreases in $1,000 or so. When interest rate increases to 15%, then 1 year bond decreases to 956, and 10-year bond decreases to 749. So in 1 year bond, the changes is not so significant. When it is 5%, 10%, the change is only positive 4.8%. When bond interest rate increases to 10 to 15%, then change is only negative 4.4%. But for 10-year bond, the changes are more significant. When interest rate increases from 5% to 10%, the change in 10-year bond is 38.6%. When bond increases from 10% to 50%, the change is negative 25.1%. Then we can say that interest rate is more sensitive in long-term bond. Here is a graphical presentation. We can see that when interest rate is 5%, then 1 year bond value is 147.62, and when in 30 year it is 100 17.68.62. When interest rate increases to 10%, then bond value in both cases decreases to $1,000. When it is 15%, the bond value for 1 year decreases to 956.552, and for 30-year bond it decreases to 617.70. When interest rate increases to 20%, the change is also quite significant in long-term bond, where the bond value decreases to 502.11. So here we can also see that the changes of interest rates are more sensitive for long-term bond. Reinvestment risk example. Suppose you just own $5 lakh playing the lottery. You intend to invest the money and live off the interest. You may invest in either a 10-year bond or a series of 1-year bond. Both 10-year and 1-year bonds currently yield 10%. If you choose the 1-year bond strategy, after year 1, you receive 50,000 in income and have 5 lakh to reinvest. If 1-year rate fall to 3%, your annual income would fall to 15,000. In 1-year bond, you cannot lock your interest rate. But for 10-year bond, you can lock your interest rate in 10%. And your annual income is 50,000 for 10 years. So now we can conclude in which case the price risk and reinvestment risk is more sensitive, in short term or long term. In short term or high coupon bonds, the price risk is low and reinvestment risk is high. But in long term or low coupon bonds, price risk is high and reinvestment risk is low. So based on this, the investor can make decision whether they will invest in short term or in long term.